Alright, this is Ubaid on behalf of Electronics, and in this video we're going to be talking about interest. Now we're all familiar with this term because we do earn interest when we deposit money in our savings account. Okay, we may also earn interest when we deposit money into an investment account, such as your ETF or any other investment product. Okay, however, interest in general, okay, is the opportunity cost of lending money for a lender. Okay, so this is an opportunity cost of lending money or the price of borrowing. And what do we mean by that? So when a lender lends money, okay, he or she gives up any other investments that he or she may want to make, right? Because this person is lending out the principal, as a result of which he or she can't invest that principal elsewhere. Let's say in capital investments, assets, okay, land, building, machinery, equipment, okay, personal expenditures, operating expenses for his business, so on and so forth. Okay, so that's the reason why it's an opportunity cost. You're giving up something to get something else. You're giving up your investments. Okay, you're giving up investments in investment products, in mutual funds, segregated funds. You're giving up investments in assets. Okay, real estate. Okay, land, building, what have you. Okay, for you to lend money to somebody else. Okay, it's an opportunity cost. All right. So when it comes to lending money, okay, the lender is compensated by earning interest. Okay, so even though, okay, the lender is giving up, okay, investment somewhere else, he or she is still earning interest. Okay, and that interest is earned because he or she is giving up his or her principal, okay, by lending it to somebody else rather than investing in his or her business. All right, so this has to do with opportunity cost of lending money. And on the other side, when a borrower, okay, let's say you go to a bank and you ask for a mortgage, okay, you go to a bank or you ask for a personal loan or a private loan from a private lender, for example. Okay, when you as a borrower, okay, borrow money, okay, you have to pay interest on top of the principal. Okay, and this has to do with the price of borrowing principal or price of borrowing money in general. Okay, so let's say you borrow $100 and the interest is 5%. So you end up paying 5% on top of that $100. Why? Because you're borrowing money from somebody else, and that somebody else is giving up that principal, is lending that money to you rather than investing in something else or somebody else. Okay, so that's the reason why, okay, interest is the opportunity cost of lending money or the price of borrowing it. Okay, now the reason why interest is important is because it helps you figure out the price of assets. Okay, especially financial assets. All right, so say for example, you go to a bank, okay, and you fill out an application for a mortgage. Okay, now the price of the real estate that you may have bought, okay, is not just the principal, because not just the principal that you have to pay off. Okay, now that you're borrowing money from the bank, you also have to pay interest on top of the principal, okay, in monthly installments. Okay, and that has to do with, okay, the price of the asset. So the price of the asset is not just the principal, okay, it's no longer the principal, but it's also the principal, okay, it's also the interest, okay, so principal and interest. All right, So apart from that, okay, interest helps you figure out, okay, different types of macroeconomic variables, which covers aggregate output. Okay, so we talked about macroeconomic policies, which covers monetary policies. Okay, we learned how when the interest rates go up, okay, the spending goes down, okay, investments go up. As a result of what GDP goes down in general because consumer spending and business investments, okay, consumer spending and business spending goes down, okay, and consumer investments and business investments go up, as a result of which GDP shrinks. We also know that the Federal Reserve, okay, by pumping money into the system, by buying treasury bonds from the local banks, okay, what they do is they expand the economy, okay, and they bump the GDP up, okay. Now, if the GDP goes to a certain extent where there is inflation, okay, because of the money being printed out, because of the money circulating within the economy, then you also have the government and the Federal Reserve, okay, bumping up the interest rates, okay. So that has to do with bringing the interest rates up and down, okay, based on the economy and the GDP, based on whether or not you're going through an inflation or a recession, okay. So interest rates and interest in general, they play a big role when it comes to macroeconomic variables. And one of those macroeconomic variables has to do with, okay, your monetary policies. All right, so that will be it for this video. On behalf of V Electronics, this is Obaid. Have yourself a great day.